So before the break, we were talking about opportunity zones with my good friend Greg Rand on the Power Play right here on Think Realty Radio. And it was a little bit of a lengthy discussion, which is really good. I mean, you need to know all the details of what opportunity zones are and how they can impact your tax liability in the future. But Greg, if you could do me a huge favor and bullet point exactly what I need to know so I can be super dangerous with opportunity zones, that'd be awesome.
I'd be happy to. And for your listeners, I know that they know you sound like a really nice guy, but they don't know you for real. Everybody always wonders, are they as nice as they seem? That was Ahbi's nice way of saying, Greg, you nerded out on us last segment with this opportunity zone stuff, and we need you to break it down and get it done maybe not in 2 hours, but maybe in 1 minute. So
there you go.
Thank you for the kind delivery of Greg. Snap it up and stop being a nerd. So real simply, okay, the tax law says that you can sell any asset, okay, a business, a Rembrandt painting, real estate, of course, but any asset sale, you can reinvest the money that you gain from that sale into businesses or property in opportunity zones, okay, those geographic areas that are low income and are looking to get a boost. So the tax benefit is that you're not going to pay any capital gains. So you made money and you're going to be able to roll all the money that you gained from whatever you sold into investments in the opportunity zone. The capital gain that you just sheltered, you're not going to have to worry about paying the capital gain until you either sell it early or you hang on to it for 10 years. So you're basically taking the money out of asset A, parking it at asset B, which is an opportunity zone investment. You don't pay the tax, but you get the benefit of the growth of that. So now your money goes into the new investment, and that investment becomes more valuable, and that gain is protected from capital gains.
Got it. So the gain, gotcha. So the gain that I had initially, I'm still paying taxes on, but the gain of the business or the gain of the real estate that I'm investing in over that time period, that's tax-free.
You're not. Yeah. And so,
that's amazing.
I put an asterisk on all this because I'm not a tax advisor. I've got them. I've really dug into this thing deep. And so I know where there's some vagaries on it, but the part that I just told you is pretty impossible to misinterpret. Okay, it's pretty straightforward. So your gain that you're protecting from a previous investment, you pay that tax later, and actually that tax actually gets reduced. You get what's called a step up in basis along the way. Again, stay out of the weeds, Greg. But the idea that your investment, whatever you put, you're starting off with more money to work with, and when you put it into the opportunity zone investment, you're protected from the gains that investment makes for a 10-year period. Investments can make really substantial gains. So it's like compounding on steroids. All right, you're taking an investment, sheltering it, and then all of that money gets protected for a decade. It's a sea change. What I love about it even more than anything else is the fact that if it turns out to be everything that I hope it is when the last guidance comes through in the next month or so, it's going to funnel an outrageously huge amount of capital is going to get funneling into these low-income neighborhoods. You're going to see improvements to the infrastructure in these neighborhoods like you can't believe. Like, there's nothing better than attaching a strategy to human greed, right? If you can get people to show, I mean, I hate no other way to say it, right?
It's a good point. It's a very good point.
This is so good. Like, it's so good. It's obnoxiously good. And so it absolutely positively will cause a huge amount of investment in these opportunity zones. There's going to be so many jealous mayors who did not get designated as opportunity zones because their neighbors, the mayor in the neighboring town, did get that bonus. And basically under that mayor's watch, there's going to be massive positive change, massive opportunity. For example, if you decide instead of buying real estate to invest in a business that's in the opportunity zone, well, guess what you have to do for your business? You got to hire people. All right. And so the proximity of the business being in the opportunity zone, creating jobs inside of the opportunity zone, because the business realized that if I locate my business over here, these are the economics of that decision. If I locate it over here in the opportunity zone, these are the economics. They are so much better. And then you just created dozens, if not hundreds of jobs in small zip code size neighborhoods in real estate, commercial real estate that might have been vacant. It might have been just not a very good use of the property at all. All of a sudden now it's it's just going to be exciting as can be. And it's one of those things where one simple change that attracts investment capital into a place and puts some rules around it, but lets it flow. It's just, I think it's the coolest thing to know how to play the American way in a way that solves problems that impact people's lives in a really positive way, both the investors, but more importantly, the folks in those neighborhoods.
You don't think this is going to be the next gold rush, do you?
You know what? That's why I tilt everything I do. If I'm hoping they make it really attractive for real estate, because if you're buying real estate, it's not a problem. I mean, you're talking about elevating the value of the real estate in these areas automatically just by increasing demand. Like, aside from the businesses opening up in the town, when you get a whole bunch of fresh demand piling into an area, they drive the prices up. So everybody wins. And they can drive the prices up without driving the rents up because they're getting such a gift in the tax break that it's not like the town's being gentrified and a bunch of low-income families are being pushed out for a bunch of hipsters to come in. It's not that. It's money coming in that's already getting the gift of tax-free essentially on the way in, so you don't have to make big improvements to the property. And that's why I'm hoping they don't make you do it. Because if the government forces you to make big improvements, what you're going to do after you make the improvements is you're going to move a higher dollar tenant into the property, which defeats the whole purpose.
That's exactly right. So we should have guidance on that probably in the next couple of weeks, I'm assuming you mentioned.
By year's end, they're promising it.
Awesome. Let's get to some listener questions. I'm excited to connect about those too. Our first one comes from Kyle from California. Finding deal flow, Greg, has been a challenge. There are tons of, quote, deals, end quote, out there, but none of which pencil out. Over the past few months, I've heard several people say it's taking them 100 deals to get to one. I'm now hearing it's taking some people up to 250 deals until they find the right deal. What can I do to find more deals?
Change your expectations. Lower them. Kyle's in California. Okay, California's real estate prices have gone so strong for so many years in a row now that, number one, all the distressed property that existed, like the business plan of I need to find a great deal, my investments aren't penciling out, is like trying to apply a 2012 business plan in 2018. You're not going to find it in California. So you got two choices. Either change your expectations in California, extend your worldview on this to be 10, 20, 30 years, use it as empire building as opposed to short-term economics, or relocate your investment plan to a different market that hasn't had a 6-year, 7-year run of appreciation. Take a little bit more of a risk, go into some other markets outside of California where you may not find as much distress, but at least you can catch the market on its way up before, you want to catch it on the beginning of a steep upward run as opposed to at the end.
I agree about the California sentiment. I also agree about lowering your expectations. So does this mean that if I'm acquiring that, and just a quick 10 seconds on this, if I'm acquiring, should I be buying at a higher price point? Or a higher percentage of fair market value?
If you want to buy property in 2018, you're going to have to offer something close to what it's worth. There aren't that many desperate or ignorant people, as to the value of their property, that is. So yeah, when I say I think the business plan for real estate investing is not about short-term gain. It's about long-term gain. It's about long-term financial independence and wealth. So it's like people are applying a day trading mentality to real estate. It doesn't work.
That's right. You got to change that and know that it's a long-term game.